Hey everybody, JJ here, Bolt to the Bust. It is Saturday, September 12th, 2020. Just wanted to put this video out today. Going to get back into the housing market, and we could be seeing a new foreclosure crisis in the brewing. Now the numbers are already not looking good, but when you look at all the other statistics we're going to look at today, it's going to prove to you that the housing market is on borrowed time. Now before we get into the details, the stats, the charts, and everything else, I want to thank everybody that came over to Patreon and supported me over there. And I just put out another Patreon only upload yesterday, another video, and we talked about a lot of things that we can't get into here because of the limitations on what we have here as far as what's allowed, but big reports on the food crisis, and it's going to get a lot worse according to the sources that I have. Also, that there's going to be a lot more violence coming very soon in the United States, and we need to prepare for it. Please head on over to Patreon. It's just a few dollars a month. You'll also help support this channel while getting this other valuable information. And again, these are more sensitive topics that fall outside the realm of just financial, but we all need to think about really protecting ourselves, because what you have accumulated and what you've earned in your life may be at risk if something bad happens to you. So check it out, link below to the homepage. That'll take you over to Patreon. Thank you everybody for your support. Let's get into the news. Well, serious delinquencies have jumped 450% from pre-pandemic levels. Not a good direction for the housing market for delinquencies. Mortgage refis are up 60% from a year ago. Missed rents also disprove this economic recovery myth. Let's get into the charts and the data here. Now, the numbers are so frightening that even CNBC had to come out with this article. Mortgage bailouts declined slightly, but a new foreclosure crisis may be brewing. As of this week, 3.7 million borrowers are still in a mortgage forbearance program, and that's about 7% of all active mortgages. All right, and here's the attention grabber in my opinion. The number of seriously delinquent mortgages that are at least 90 days past due more than doubled from May to June. Now in May we were already in lockdowns. The lockdown started back in March when this thing started spreading, and it's at the highest level now. These delinquencies are at the highest level in more than 5 years. That's according to CoreLogic. So serious delinquencies have doubled from May to June. We're still waiting for the July numbers because CoreLogic only puts them out every few months. But look at this and look at these numbers and think about, where is the economic recovery that we're being told about? Where is the V-shaped recovery? Supposedly, if you believe the official numbers, which I think most of you don't believe it, like I don't believe it, but if you believe the official unemployment numbers, unemployment's dropped. There should be more people now able to pay their mortgages, right? Well, no, mortgage delinquencies doubled in just those few months during the lockdown. This is not good, and it disproves this economic recovery myth. And we're going to talk about the rental numbers. Those are also pretty awful. And housing, it really could be about to get smashed. The housing market could be about to get crushed. Now they could extend it. They could have new rescue programs come in. They could have maybe a massive debt forgiveness. They could pull something out of the hat that's never been done. You know, we don't know what's in the cards, but we do know that this thing is on thin ice. More than 2 million forbearance plans are set to expire at the end of this month, at the end of September. That's also out of the same article. Right? Also, the low mortgage rates, it's getting people to get into the housing market. We also have people leaving the cities. We've reported on that a few times. More people leaving the cities with high rents and going and buying homes now because they can work remotely, a lot of them. A lot of them were just scared of the infection and also the rise in violence in these cities. So home ownership jumped, so that demand really took a stronghold on home buying, and we saw a big surge in home sales, aided by ultra low mortgage rates. New records set for low mortgage rates, seems like every week now. But look at this, mortgage refis are up 60% from a year ago. And we have to ask ourselves, how many of these mortgage refis are cash out refis, people pulling equity out of their homes with home prices still rising and now way beyond where they were at the peak of the last housing bubble. Right, and that's another thing. If there was a housing bubble that everybody admits back in 2007, 2008, and now home prices are way beyond where we were back then, you still have people saying that we're not in a housing bubble now. Okay, but let's be clear, just because we're in a housing bubble doesn't mean they can't extend it further. We could see 2.5%, 2%, 1.5% mortgage rates. The Fed could come in even more heavy-handed on the mortgage-backed securities and help push mortgage rates lower. Right? Nothing is off the table. Anything's possible. But we do know when this thing corrects, when something happens, when there's a glitch, when the Fed trading desk has a blackout, look out, because this thing's going to correct in a very wicked fashion, in my opinion. Right? So we're seeing these things happen at the same time. Mortgage refinancing and delinquencies are soaring at the same time. So there's a lot of desperate people, it looks like, needing to get that lower payment. Recent article here out of NASDAQ.com talks about it. Mortgage refinances are up 200% from last year. And I'm sorry, I have to go back. At the beginning, I had 60% in there. It's 200% from last year. And some people say I'm doom and gloom. I actually don't stress enough about how bad things are. Right? So it's way worse than the 60% that I put down. Sorry about that. 200% from a year ago. And this article right here asks the question, should you hop on the bandwagon? Well, be very careful. Low mortgage rates are enticing. You can lower your monthly payment. But usually you're always increasing your debt, especially if you take cash out. But when you factor in the extra closing cost and when you add more years back onto the loan, you're increasing the total amount of interest that you're going to pay over the life of the loan as well. So be very, very careful. This is starting to look like 2007 all over again. It's been looking like 2007 for a while, but they keep on coming up with new tricks with the forbearances, the banking system life support, the liquidity injections, which the Fed doesn't need to do anymore because the banks now do not have to have any money in reserves. The constant lowering of the mortgage rates, the Fed coming into the mortgage-backed security markets. Right? The Fed has vowed to offer unlimited backstopping of these markets. Right? But a stimulus check for you and me, no, we have to negotiate for months and months and months, and we have to come to an agreement before we can offer a rescue package for the American people. You see what's happening now? It's pretty simple to see if you're paying just even partial attention to this. Finally, let's talk about rents. Rents give us a true picture of the cash position of the U.S. consumer, in this case the renters. So with this amazing recovery and the lower unemployment rate that we're seeing, even though it was about 880,000 new unemployment filings last week, we're still being told it's an amazing economic recovery. I don't know how anybody can believe that, but if you look at the CNBC today and some other business channels, they were talking about what an amazing recovery we're in and how we need to jump into the stock market. But let's touch on the last bullet point here. Missed rents disprove economic recovery myth. Recent article here out of apartmentlist.com. If we see the monthly chart here, it shows each month since the beginning of the lockdown starting in April here, and we saw it spike to about 32% of people missing their rent payment. Spiked up to 36% in July, 34% in August, so slight decline. 32% though this month, people missed September's payment. So just from a drop from 35% down to 32% of people that can't pay their rent, does that seem like an amazing economic recovery? Right? So 32% still could not pay their rent in September, either could not or did not. Now maybe some people could have paid the rent, but they chose to just hold on to the cash instead and take advantage of the eviction moratorium. I hope not too many people are doing that, but we'll see how that works out for them. So now still nearly 1 in 3 people can't pay their rent. Is this the amazing economic recovery that we're being told about on the TV? Right, the mainstream economists. Right, everybody, let me know what you think down below. Please let me know what you're seeing in your area. I'd like to hear from you. Also, again, a reminder, head on over to Patreon. Link down below to the homepage. There'll be a icon there for the Patreon uploads. You can support me by going there. You can get a little more up close and personal if you'd like to. You can ask me questions over there. I can more easily respond because there's not thousands of comments to sort through. Thanks everybody so much for your support. Hope to see you back on this channel. Please like and subscribe. Come back for more. See you then. Hope you're well. Stay safe. Until next time, everybody. Peace.